Hey there. Ever thought you could be a millionaire just by stepping into another country? That $1 in your pocket, the one that buys a pack of gum at home, can get you 26,000 Vietnamese dong in Vietnam. Imagine $50, that's over 1.3 million dong. Not bad, right? Tomorrow, when you see your friend, you can casually pat him on the shoulder and say, "Hey Jimmy, call me a millionaire from now on." But then you go to the UK, and your $1 only gets you about 0.8 pounds. Maybe enough for a tiny chocolate bar. Talk about a reality check. You might be wondering, why can $1 get me a mountain of Vietnamese dong, but not even a full pound in the UK? Why do I feel like a millionaire in Vietnam, but poorer in the UK than I do at home? Why isn't money worth the same everywhere? So, what's up with that? In this video, I'll take you into the world of exchange rates, show you why $1 is not equal to 1 pound, is not equal to 1 dong, and explain what factors make currencies more or less valuable, and why the whole world doesn't just use the same money. But before that, we need to know an important moment in the history of money, because around that time, the very nature of money changed dramatically, directly leading to the form of money we see today. That moment is when the world moved off the gold standard. About 2,600 years ago, the first gold coins were minted and used for trade. But over time, people realized that carrying around gold wasn't exactly convenient. Think heavy coins, hard to make change, and don't even get me started on thieves. So they came up with a clever idea. Store the gold in well-protected vaults and use receipts from the vault to buy goods and services. These receipts could always be exchanged back for the gold in the vault, and since nothing ever went wrong, people slowly got used to this system. Yep, that's how paper money was born. And funny enough, the very first paper money was literally just a receipt. From there, the story of money really begins. At first, most currencies were directly linked to gold. This is what we call the gold standard. People could take their paper money to the bank and exchange it for real gold. For countries, this was a natural check. If they printed too much money without enough gold in reserve, people couldn't redeem it, and trust in the currency would collapse. Basically, it stopped governments from just printing money without backing it up. But after the 1940s, with globalization and economic growth, countries needed more money to keep trade and investments flowing. Wars and recessions made this even trickier. Suddenly, the gold standard, requiring one-to-one gold backing, was hard to maintain. So countries started moving away from gold and introduced their own fiat money. Fiat money isn't tied to any physical thing. It's basically just a piece of paper with $100 on it. So why is it worth $100? Because the government says it's $100 and people choose to believe it. Or, well, we kind of have to believe it. Since it isn't linked to anything tangible, its value depends entirely on people's trust and whether people want it. If lots of people want this money, its value goes up. If no one wants it, its value goes down. So there you have it. Money's value comes from supply and demand. When supply is bigger than demand, value drops. When supply is smaller than demand, value rises. Think of it like this. Brands like LV or Nike sometimes release limited items while demand stays high. Less supply, higher price, it's the same principle. So the big question is, how do countries actually manage their money's supply and demand to control its value? Way one, interest rate. You probably know this word already, interest, but let's break it down in the simplest way. If you lend me money, I'll give you back the money you lent me plus a little thank you bonus. That extra part, that's interest. Now, let's scale this up to countries. When a country wants its currency to get stronger, one of the classic moves is to raise the interest rate on its government bonds. Think of bonds as you lending money to the country. It promises to pay you back later, plus some interest. By raising interest rates, the country makes its bonds more attractive. Foreign investors go, ooh, higher returns. But to buy those bonds, they first need that country's currency. More demand for the currency usually means a stronger currency. Sounds simple, right? Just crank up the rates and boom, the currency skyrockets. Well, not so fast. Here's the catch. Higher rates aren't free candy. Think of it like concert tickets. If tickets are cheap, everyone can go. If tickets are insanely expensive, sure, you'll get scalpers and rich people buying them. But regular fans, they're priced out. Same deal here, why higher interest rates attract foreign money, but they also make it harder for local people and businesses to borrow. Fewer people buy houses, companies struggle with loans, some even go bankrupt. Unemployment rises, and suddenly the economy slows down. So it's a balancing act. Rates need to be high enough to attract investors, but not so high that the home economy gets crushed. And that's why whenever Jerome Powell, the head of the Federal Reserve, announces a rate change, the whole world holds its breath. The Fed isn't just America's central bank, it's basically the world's most influential one. Simple say higher interest rates can strengthen a currency by pulling in foreign investors. But crank them up too high and you risk hurting your own economy. Way too inflation. So here's the thing about inflation. It usually happens when a country just prints way too much money. For us normal folks, what does that mean? Well, imagine this. 10 years ago, you could grab a dozen eggs for $2. Today, the same eggs cost $4. The eggs didn't change, but your money sure did. It's worth a lot less. And if we're talking crazy inflation stories, oh man, Zimbabwe takes the crown. Back in 1998, one US dollar was worth about 24 Zimbabwe dollars. Not bad, right? Fast forward to 2006, and suddenly $1 gets you 100,000 Zimbabwe dollars. The government looked at all those zeros and basically went, yeah, that's too many. So they hit the reset button. They made a brand new currency called the ZWN, where 1 USD equals 100 ZWN. Problem solved? Nope, not even close. A year and a half later, $1 got you 30,000 ZWN. 6 months after that, 2 million ZWN. You think it stops there? Ha! Just another 6 months later, $1 equals 500 billion ZWN. At that point, the government was like, okay, too many zeros again. Let's chop off 10 of them. Boom, new money, the ZWR. Now 1 USD equals 50 ZWR. Kind of funny, right? But people weren't laughing anymore. Nobody trusted the money. Then comes 2009, the grand finale. Zimbabwe printed the world-famous $100 trillion note. Yes, trillion, with a T. At that point, 1 US dollar equals 300 trillion Zimbabwe dollars. And guess what the government did? Yep, another reset. They deleted 12 zeros this time and rolled out the ZWL. But honestly, by then the game was over. Citizens gave up on their own money. They just started using US dollars and other strong currencies. And finally, the hyperinflation stopped. Everything stayed calm for about 6 or 7 years, and then, surprise, the government brought out yet another new currency, the ZWG. And do I even need to tell you what happened next? Yep, same story, different name. So, currency devaluation sounds scary, right? Then you might be thinking, well, why don't countries just keep their currency super strong and become the most valuable currency in the world? Here's the catch. Having a strong currency isn't all sunshine and rainbows. In fact, for countries that rely heavily on exports, a stronger currency can actually be deadly. What do I mean by export countries? Think of them like giant factories. Their main way of growing their economy is by selling stuff to the rest of the world. The classic examples? Germany and China. Germany is famous for high-end products like cars and machinery. Things known for quality and precision. China, on the other hand, is known for affordable everyday goods. You know, when you're scrolling Amazon and see socks or hats made in China for super cheap, and you're like, wait, how is this price even real? Is this a scam? No, that's actually a big part of China's strategy, keeping their currency a little weaker so their products stay cheap abroad. But imagine if China's currency just kept getting stronger and stronger. What would happen? First, foreign buyers would cut back on orders. Why? Because if the yuan rises, that means buyers in the US or Europe have to pay more dollars or euros for the same Chinese product. Too expensive, fewer orders. Second, Chinese exporters would see profits shrink. They're earning in dollars, but when they convert those dollars back into stronger yuan, they get less. Costs at home, like wages, energy, and land, don't go down, so profits get squeezed. Finally, if the yuan rises, foreign goods suddenly look cheap to Chinese consumers. People start buying imported cars, electronics, even farm products, and that crushes local industries. The thing is, exports have been a huge driver of China's GDP growth over the past few decades. If the currency gets out of control and rises too much, it's like slamming the brakes on their economy. Growth could stall or even go backwards. And that's something China really can't afford. So yeah, stronger currency sounds nice. But for some countries, it's more of a nightmare. Way 3 risk. All right, the third big thing that affects exchange rates is risk. And honestly, this one's pretty easy to understand. Imagine you're a rich investor. Would you put your money into Russia or Ukraine right in the middle of their war? Probably not, right? Why? Well, maybe you'd be worried your assets could literally get destroyed with no one paying you back. Or maybe you'd worry that because of the war, it'd be almost impossible to sell your products. Even if you did manage to sell something, the local currency might be dropping in value every single day. Until one day it's basically just paper. That's the thing about risk. Different people might be worried about different details, but it all leads to the same decision. Nope, I'm out. Not going to invest there. And when investors run away from a country, or refuse to put money in to begin with, the value of that country's currency just tanks. A real example, when the war between Russia and Ukraine broke out, the Russian ruble crashed hard, down about 60%. Before the war, 75 rubles could get you $1. At the worst point of the crisis, it took 130 rubles to buy that same dollar. So yeah, risk matters a lot. And now you can see exactly why. So here's a question you might be wondering. Why doesn't the whole world just use one single currency? I mean, wouldn't that make life so much easier? No more messy exchange rates? No more converting dollars to yen or euros to pesos? Maybe we could just call it the Earth dollar. Sounds nice, right? Well, not really. Here's the problem. Let's take the euro as an example. Countries that use the euro basically gave up control of their own monetary policy to the European Central Bank. And for a nation giving up control over your own money, that's a huge risk. There's even that famous quote often linked to the Rothschild family. Give me control of a nation's money, and I care not who makes its laws. The idea is simple. Laws may look like they run the show, but money and finance are the real foundation of power. If someone else controls your currency, they can influence your government and economy in ways you can't stop. And here's another big issue. If the whole world shared one currency, what happens when just one country falls into an economic crisis? The central bank of the Earth dollar might say, hey, sorry, we're not going to change global policy just to save your country. And that means your country's economy could spiral down with no lifeline. Even worse, because we'd all be tied together with the same currency, their crisis would quickly become your crisis. Imagine this. You're living your best life in the US. Nice house, fancy car, and then suddenly inflation wipes it all away. You look around for the cause, and it turns out some country halfway across the globe completely tanked their economy and dragged you down with them. It's like you're working hard in America, and because some other country sneezes, you end up catching the cold. Simple say. The reason $1 can be exchanged for different amounts of other currencies is all about supply and demand. The more people want a currency, the more valuable it is and the more it can buy abroad. Countries control their currency's value by tweaking things like interest rates, inflation, or other tools to manage supply and demand. This helps them gain an advantage in the global market, whether it's importing goods, exporting products, or attracting investors. And even today, the world still hasn't switched to a single global currency. Why? Because no one wants a situation where a financial disaster in one country, hundreds or thousands of miles away, suddenly hits everyone else.